All right, we are focused on oil. Crude down for a second day in a row, but there's no denying that crude certainly has rallied, maybe even defied expectations. We are up significantly in 2024, and that's taken the Canadian energy producers along for the ride. Let's bring in Randy Ollenberger, Managing Director of Oil and Gas Equity Research at BMO Capital. Thanks so much for being with me.
My pleasure.
So, we talk about this disconnect in the gold stocks, almost like a disconnect between the price of bullion and what these stocks are doing. The equities in oil have participated quite nicely in the rally.
They have. So, oil is surprised to the upside this year. I don't think the market was anticipating an $85 oil price, maybe in the second half, but not in the first half of the year. And so that's really driven the outperformance that we've seen so far this year. I think the other factor is the stocks are relatively inexpensive. So even though we've had that outperformance, I think investors are looking at the stocks and saying, you know what, there's a lot of yield potential here that's not being fully priced in.
I'm wondering what you're using relative to what? Relative to their historical valuation, relative to tech stocks?
Yeah, well, both. If you look at the discount to the broader market, it is at a historic low. But even if you just look at consensus multiples over the last 20 years for these stocks, they're trading at the bottom end of that range.
And you've been doing this for a long time. How has investor sentiment shifted? Has it brought back the generalist, the foreign investor?
It's starting to. So, right now we've got the BMO Cap Energy Conference going on here in Toronto, and, investor attendance is up 30% over last year. So we're definitely seeing bigger interest in the space from those investors.
And do you get the sense that that's kind of long-term? Is it people looking to trade in and out? Or is it a sector that you think, now is viewed as it should be a core part of your holdings? I
think the people are looking at it now, are looking at it as a core holding based on income. So it's really the yield potential of the space. So, we've got a lot of these companies buying back 10% of the shares and paying a 4 or 5% dividend. So that's a very attractive return of 10 to 15% that goes into shareholders' pockets. So I think it's the yield potential that's attracting people, and that makes it a bit more of a buy and hold space.
This is a sector that has seen a dramatic increase in cash flow, have seen a dramatic increase in the ethos, right? Or not an increase, but the ethos is we're going to take this money, we're going to give it back to shareholders. Over this time, can you quantify how many billions maybe have been paid down in debt? How financially healthy are these companies compared to previous cycles?
Yeah, so, they are in the best financial health ever when we look at those balance sheets, and they're generating the highest returns on capital employed ever. So the financial health of the sector is very, very strong. In terms of debt reductions, we've probably seen something in the order of $50 or $60 billion worth of debt retired over the last couple of years. And in terms of free cash flow distributed to shareholders, last year we probably had about $40 billion. It'll be more than that this year. So there's a significant amount of money that's going into shareholders' pockets.
We will get a sense of how the sector is doing when these companies start to report at the end of the month. We have Imperial, the beginning of May, we have Cenovus. What's the setup going into the quarter? What do you expect to see relative to maybe consensus?
So a big driver is just simply going to be the improvement in oil prices over the first quarter. So oil prices have strengthened. That will drive some pretty strong performance and strong quarterly results. We've also seen some good strength in the downstream. So companies like Suncor and Imperial Oil, we would expect to have some good downstream performance in the first quarter as well. So I think the first quarter is going to be a good quarter for the sector and could provide incremental catalysts for the stocks.
M&A. I know it's been selective. It's been major in the U.S. How do you see that playing out, if at all?
Yeah, we still think there's a possibility of M&A, certainly on the natural gas side of things as we near the in-service of LNG Canada. We think it makes sense to see some M&A there. And on the oil sands side of things, most of the sector has already been consolidated, but we do see the opportunity there as well.
You're neutral, though, on Suncor. Take me into the reasons.
So, they've had a lot of operational challenges over the last several years. Their new CEO, Rich Kruger, has done a very good job at improving the operations, improving reliability. But they still have to deal with the big issue, which is mine replacement. And so they're still a little further away from hitting their debt targets. They have a debt target of $9 billion. They're about 13 and change right now. Once they get to that 9, they will start distributing 100% of their free cash flow. Their peers, C&Q, they're already there. Cenovus will be there in a quarter or two. Imperial's there, MEG's there. So Suncor is a bit of a laggard in terms of reaching that debt milestone.
We've been talking a lot about the oily names. Let's talk about natural gas. It's been a tougher slog.
It has. So, warmer than normal winter weather in both Europe and in North America has certainly undermined the natural gas price. We think we may see even weaker prices this summer. We simply have too much natural gas right now. The good news, weaker than we're seeing right now. So the good news, though, is that we do have LNG Canada starting up at the end of this year. And so 2025 should be much, much better for natural gas in both Canada and in the United States, because there's a lot of LNG capacity coming online in the U.S. as well. The problem is the producers are producing all of that gas for those facilities now without having that home. So when that home opens its doors, if you will, the price should start to improve.
Can the companies hang on until then? You have a market perform on Birchcliff, on Peyto. Birchcliff cut their dividend, but it's 7% dividend yield, which is still high.
Yeah, so, Peyto, in fact, has a very attractive dividend yield as well and is very well hedged. So we don't really see any dividend risk there. Birchcliff cut their dividend because they're paying out of debt. Now, the reality is, with gas prices potentially moving lower this summer, they'll be paying it out of debt still. But, the balance sheets are probably strong enough that they can hold it. So
their ethos, of course, is unhedged, famously unhedged. Do you feel like that could change or should change?
I think it could change. I think it makes sense to have a portion of your portfolio hedged if you're a natural gas producer, just because there's so much volatility in natural gas pricing because of weather. Weather has such an outsized impact on natural gas prices versus, say, oil prices.
Highest conviction idea?
Canadian Natural Resources and an Imperial Oil.
And already at record highs for definitely CNQ. You see it going even higher.
I do, because they're going to be paying out 10 to 15% cash to shareholders, so that's a nice return on its own. They're going to be splitting the shares here in May. We think that could actually be a catalyst for the shares as well.